prices will converge across different venues. These are mostly driven by relative volumes on each exchange. We want to remember the notion of confidence throughout. If we deem two perps to be very similar, we can give a higher confidence to it and then size up on a divergence to a greater extent. How that score is developed is up to you as the reader, but generally it should include components like interval index formula, funding limits, and accrual formula. In any of these trades, the funding rate can play a significant role in divergence if contracts are misaligned. Thus, we should take these into account for our final live version entry-exit timing. Timing our entries and exits for most firms is a simple moving average or perhaps even an exponential moving average with a set look back period. This look back period can be equated between the parameters for an SMA and EMA formula below. In addition to this, we have a parameter typically with a value of 2 to set the number of standard deviations from this threshold that will enter into a trade with a baseline assumption being that we exit when the price reaches the mean. We do not have to exit when price reaches the mean and can instead exit earlier. As we can see in the above diagram, the expected mean reversion between T1 and T2 written EMR T1, T2 in our diagram is proportional to the absolute z-score of the spread. The expected mean reversion roughly says how much we expect the absolute z-score to decrease by towards 0. Between two different time steps, I've drawn the relationship as linear, but it could be exponential or plateau out at a higher score, maybe even going negative, likely due to liquidation-based momentum caps on funding rates that you'd see these effects. We'd need to look empirically to see the true relationship, but the general idea stands for now. The issue is that the volatility of our spread can roughly be assumed to be constant, if anything. It is proportional to the absolute z-score, but let's call it a constant because it's an acceptable assumption for the explainer. The expected mean reversion is our edge. So we have a ratio between our edge and the volatility. As we see more of a reversion, the edge shrinks, but our volatility stays the same. So we get a worse risk-reward ratio as the spread reverts. When we add in the risk of mean estimation errors, differences in moving averages,
make
parameters,
a choice, right? You just decide what it's going to be, who you're going to be, how you're going to do it. Just decide. And then from that point, the universe is going to get out your way. It's like it's water. It wants to move and go around stuff, you know.
Yo, keep the questions coming in, dude. If we get enough questions, I'll bring Homeboy on, but if we don't, then no way. It starts to become questionable whether we should hold entirely to the mean or exit slightly before. Thus, we have a third parameter, our exit z-score. It is worth noting that these trades compete aggressively on the ability to beat fees, costs of trading. We could end up tying up capital for ages, sure, but we also could end up giving a couple extra BPS that mean the world to us when we're only working with a few bips after transaction costs in all likelihood. I write this all down so the traders can make their own decisions and so that you know what the experiments are that are needed to be conducted. Not so I can spoon feed the alpha step by step. No one will do that for you. Implementation. This section implements a backtest for a basic taker version of the strategy. We will explore a few different days of interest and go from data scraping all the way to our P&L plot. For me, at least, the pipeline looks exactly like this every time. Data scraping, data pre-processing, analysis continued, expanded analysis optional. In this case, I expect the analysis to be a basic opportunity test, and then from there, the analysis will develop a backtest. Then finally, we would do an expanded analysis which would include additional factors. Those additional factors would likely be latency or trading costs, which we vary to see the impact. Each of these 5 steps represents a IPY notebook. The alternative for me would be an open PY file and start building tooling if I'm expecting this analysis to be more than just research. Other researchers need to validate my findings too. If it's going to take up lots of implementation resources like this strategy would, since lots of the alpha is on latency, data scraping, we'll be using tools like TARDIS as our data source. The most nice, dude. There's some alpha. Tick by tick order book snapshots. Cool, bro. Thank you. TARDIS. BitMEX, Deribit, Kraken, Binance. Okay. I wish I had access to some of these though. Okay, so he's doing some coding here. Half of these are default imports because the cost of importing is very low. And I typically copy paste the imports block from another block notebook. So realistically, there is no cost to importing libraries I expect to be using. Technically speaking, we can get away with just these. We're using Python, IPython environment. So we need to nest asyncio. JSON will be used to open source the JSON file with the TARDIS API key. The TARDIS dev is, of course, the TARDIS library for downloading. TQDM is a helpful library that makes the loops a lot easier to track the progress of. It's pretty helpful when you have hours-long downloads. We could end up using requests if we were fetching symbols from the exchange using, okay. Before we do that, let's define this. So we're doing some requests here, pulling some data. Data dog's gotta be a data dog. So these are the exchanges using Bybit, DYDX. For tickers, I also want to filter by market capitalization. So it's all crypto, which is cool to see. Now let's define our look back date, data types, and open our TARDIS key here. Time to scrape the data. Here's a big chunk of my code that I usually copy and paste about. So it's going through the exchanges and getting the data sets for each symbol. My download directory is specifically set up based on the structure of my research data on my laptop. You may ask, why not do it all at once with multiple data types and multiple symbols? Well, that's because it has a fit if you give it too much data to download at once, so I prefer to do it in smaller chunks. But it is really up to you to experiment with a bit more concurrency in your downloads. Don't worry. If you get a ton of these, it just means that the symbol isn't on that exchange, remember. All we need is for the symbol to be at a minimum of 2 exchanges. It doesn't need to be on all of them. You may also want to increase the date range we pull. I made mine short to save time, but I've used whole years for this kind of analysis in the past. I usually recommend doing a day and then going straight into writing the backtest code. Then you can rerun the data scraper to scrape more data. This prevents you from sitting at the desk reading the book paper whenever you do in this time, because you can claim the data is scraping. Okay. Data preprocessing. Our data is normalized already because of the TARDIS formatting, but it's also GZ compressed and has a load of useless columns. Here's how we merge multiple exchanges. Okay, so this is nice. It gives all the code. I'm not going to read the code. This is pretty. If we run the code like this, exchanges to merge by bit. Okay. Merge exchanges. Then we should get this. Okay. We have two functions here. One merges TAQ, trades and quotes, on a per exchange basis, and another merges quotes cross exchange. We'll use the TAQ data for the limit under optimization analysis and the quote data for the initial opportunity exploration plus backtest. Our data appears to be processed, although our data selection is limited. Ignore the extra day I added. I scraped that after the backtest. A quick test in our notebook reveals this has worked properly. This is all satisfactory. On a further inspection, the data looks well formatted. If you want to open multiple of them at once, then you can use this snippet to aggregate them by date range. OS and pandas should be imported directly. So you need to import date time. Let's wrap up by talking about how the code works. We've decided to use quote data in our events, but typically we would have quotes and trades simultaneously and then fill forward only the quote values. We would loop through it by saying if the trade column is our choice our choice is non, then it's a quote update. And if it's not non, then it's a trade update. We're allowed to fill forward quote values, but not trade values. Once we get a quote message, we can assume that the quote is valid until the following quote is given. There are some very low latency issues here when you start to care about the sub 100 milliseconds, and especially the sub 30 milliseconds frequencies of data. Even order book events will be aggregated, roughly 30 milliseconds updates on Binance real-time updates, as long as you assume some decently sized latency between your deciding to make a trade and you actually simulating your fill. You should be fine. For context, we include trades in our data because trade data is very useful for a lead lag analysis, which we will discuss later. Volume plays a prominent role and at a very trade focused level still. We won't be implementing this, so I didn't feel there was a need. We do still need trade data, but not all the trades for all exchanges at once, since we estimate limit fill probabilities on a per exchange basis. Checking for opportunities. This motherfucker. I hate it here, dude. I hate it here. I can't believe this. I read like 45 minutes of this paper. Oh my god. I hate it here, bro. I'm not, I'm out. I'm out. I should have checked that first, dude. I should have checked that first.
Imagine you had everything you wanted. Everything. Imagine you were everything you ever wanted to be. And capture that feeling. That's the easiest way to manifest what you want.
That's killer, B. That's killer. That's killer, B. Come on. Give me all that. Let me have all that. Let me have all that. Please, please, please. Please let me have all that. Let me see it all. Let me see it all. Give me your all. Give me your all. I want your all, dude. The name of the article or the author? Yes, algos.org. And the author is quant.org. I'll put the link in the chat. The link is in the chat, dude. The link is in the chat. The link is in the chat. Alright, we might hit a paywall for all these. Market making for Doge. Actually interested in this one, Psych. Part 2, okay. Okay, I mean, HFT research for dummies. Let's read through this a little bit. Today I'll talk about some general functions and activities in HFT research. It's not an all-encompassing guide by any means, but this tooling should end up being useful for you in your research endeavors. Certainly, these are common tasks I have encountered. Order book impacts, snapshot. Usually, we just need to find out whether the strategy works in the first place, and we infer the capacity from the liquidity of the assets we trade. But in other occasions, we need to figure out the impact of a certain size on the order book, or otherwise use this data to find the capacity of the strategy itself. So TARDIS.dev is what he's using, dude.
Market data connection lost.
Market data connection loss.
Market data connection re-established.
You're welcome, dude. start by pulling some data for USDT. So this shows you how to pull the data for Bybit. Okay, that's cool. Wow, that's a lot of data for 2 days. Anyways, we often need to find out the impact of our trades given a timestamp. This can fail when our size is quite large, however. At this point, we can either use the empirical data and then extrapolate from there by fitting the square root law. You can use the standard square root law, that's pretty accurate, or tune over a much longer horizon. I won't go into this too much, it's a dirty fix. We don't want to reconstruct the book on a live basis, which brings us to the next section. There are a few reasons to prefer the use of incremental order book data over snapshot data. It's far smaller to store on the disk because it avoids duplication. It comes from the feed that is typically slightly faster and would be the one used in production. It shows much more levels than the snapshot data. Continuing from our previous data scraping, we'll be using TARDIS with the same symbol in exchange. We can then go build and code to transform into snapshots, but generated live. When it comes to
I'm not
HFT
afraid to
strategies,
die on a treadmill. You might have more talent than me, you might be smarter than me, but if we get on the treadmill together, right, there's two things. You're getting off first, or I'm going to die. It's really that simple.
when it comes to HFT strategies, you often reach a point where latency cannot be ignored. Simply having great alpha and modeling is not enough. You also need to be competitive on the latency front. 777, Andre, good to see you. Most of this is concentrated on the cloud network engineering front, so let's implement some practical experiments. Ones that would typically be performed inside a top-tier firm's latency research operations to develop optimal network setups. Why latency is key.